Listen, I get it. I'm an accountant. I feel like they're a dime a dozen. There's hundreds of thousands of us out there. And if I have been able to stand out in like the most boring freaking industry like tax, you can stand out in your industry too and make a shit ton more money.
Welcome to Life Changing Money, a podcast all about one of the most taboo topics in the world, money. I'm your host, Barbara Streehans, and we're going behind the scenes on business owners' journeys to money, success, and wealth. Let's get started.
Hello, and welcome to another episode of Life Changing Money. This week is another solo episode because I have so much to say on all things real estate. So if you have been watching on our social medias, you know that we are relaunching our Write Off Your Real Estate course. We have only historically done this once a year, and this is the only time we're launching it this year. So don't miss out because you'll have major FOMO. But sign up for the Write Off Your Real Estate Masterclass on May 1st, 10 a.m. Pacific, and you want to be there live. There's going to be extra bonuses for those that attend the Write Off Your Real Estate Masterclass live. And what you guys know, if you've purchased a course from us before, we always add new content, new modules every time. So today, actually, we're like in the recording studio, adding more content and modules to the Write Off Your Real Estate course. And this time we're adding even more modules on 1031 exchanges. Like, yes, everyone's heard of a 1031 exchange, but there's so many cool scenarios than what you just imagine as like, oh yeah, I'm going to sell my property and buy another investment property. But we're adding in like cool situations that you might not have ever even heard of. We're adding in reverse 1031 exchanges, which you also probably haven't heard of. The slow man's 1031 exchange, which like nobody talks about and is so cool. We're adding in modules for the side door 401k. And again, these are just like tips, tricks, strategies with like cute nicknames that I've made up because like nobody talks about these things. We're also adding in for some of you when you purchase quick, because we always reward the quick decision makers in their business because success loves speed. Some of you will be getting a mastermind call with my favorite lender and I. And in that mastermind call, you literally get one-on-one advice in a group setting. So like you're with 12 other real estate investors or those that want to invest in real estate. And it was so cool last time we launched this. When we did it, we had people on the calls that had 500 doors and people on the call that had no doors. And the amount of like ideas and strategies that we were able to come up with for our clients that purchased the course was so amazing. So many people have bought more properties since they purchased the course, and not only purchased properties, but now they're saving a shit ton of money in taxes, which is like the whole point, right? Like we've all heard real estate is what makes you wealthy. And we're literally teaching you how with all the tax strategies. And some of you will even get our trusts and estate course. We launched that course this year. It's over $700 just for that course. And some of you will get it when you purchase the course as well, because the biggest thing with real estate is how you structure it. And all of you guys need to know how to structure it in your trusts and how to add it in to your estate plan. So again, just DM me anywhere on our social media as real estate, and I'll send you the link to the free masterclass. Or you can click the link in the show notes below so that you get your spot. This masterclass is going to sell out. I mean, it's a free masterclass, but like you have to cap the number of people because Zoom charges like $5,000 if we go over the number of attendees. And since we only launch this one once a year, you're going to want to hop in fast. So this episode, we are going to go over a bunch of questions that we got from the Write Off Your Real Estate course last time, from the masterclass last time, because I think it's always so helpful, like when people have questions, to hear their questions, because we don't know what we don't know. And when you hear one, you're like, oh, I never even thought of that, but this is just so good to know. So question number one, can my winery, first of all, that's cool, If you guys didn't know, I'm from Paso Robles, California, and it's a wine country. So a lot of my clients own wineries and a lot of my friends own wineries, which is a good perk to have. Can my winery build an ADU guest house in our backyard and use it as an office? Well, this can apply for any of you with any business or even a real estate business, like even if you're just a real estate investor. Yes, you can build another dwelling. For those of you not in California, ADU means accessory dwelling unit, which just means like a small house. I think the square footage has to be like less than 1,200 square feet if it's not attached to your house. And then less than a junior ADU is less than 800 square feet attached to your house. So typically people will put it like on top of their garage or whatever. So can my winery, AKA business, AKA this could be you for a real estate investor, build an ADU guest house in our backyard and use it as an office? Yes, you can. And what's cool is that construction fee is already broken out for you because like the only thing you're building is that accessory dwelling unit. So let's say you get a quote for $150K from the general contractor, and that's what it costs, hopefully, although it's typically over once you're done. But let's assume it costs you $150K. Then you're going to be able to depreciate that $150K in whatever business or real estate LLC that you're taking it on. And in addition, you might want to get a cost segregation study to accelerate that depreciation. I went over a whole cost segregation study example in the last podcast I did on real estate. So you can look it up there. Just look up Life Changing Money and you'll see an episode with me talking about real estate. So yes, you can. Yes, you can take it as a depreciation expense. And then once the construction is done and you want to furnish it all cute, because we all want to have cute offices, then all the furniture can be depreciated. If it's under $2,500 per item, like let's say the chair I'm sitting in was $1,000 and then the couch I'm looking at was $2,000, those items can be expensed, which is cool. If something's over $2,500, it's also totally fine. It just has to be depreciated in that entity. So make sure you have a tax strategist, you have an accountant that really knows real estate, that knows about ADUs and building guest houses, that knows about cost segregation studies. Like you need an accountant that knows real estate. And hello, I'm her. Okay, next question. We have an interior design business. Fun. We purchased our first house, a fixer-upper. I swear every interior designer I know purchases a fixer-upper. It's like their favorite thing. Sounds like hell to me, but you guys have fun fixing that up. We're wondering if any part of the renovations will be a write-off. We are attributing one room to be our office as well. Okay, I do get this question a lot from interior designers. We have a lot of interior designer clients and influencer clients, and they will ask me, I'm renovating my living room or my kitchen or my entire house, and I'm going to record it all and post it as blogs and post it as, content on my Instagram and TikTok, and I'll post the affiliate links and all of that. Can I write it off? No, you cannot. And don't shoot the messenger, but the IRS does not like any areas that is mixed use, meaning, okay, we get this a lot from nutritionists as well. A nutritionist or like a fitness person that uses their kitchen to record recipe videos and like do recipe research and all of that fun stuff. Can I write off my kitchen remodel? No, you can't, because you use your kitchen personally otherwise. Like it's mixed use. You mix the use with personal and business. The same with this interior designer's house. Now, if they were fixing it up, rehabbing it, and flipping it as an investment property, then yes, they could. But if they're using it as their primary residence, no, you cannot. But what you can write off is, like they said, we're attributing one room to be our office as well. Well, that one office that one cost of construction for that one little corner of the house could be a home office expense and depreciation expense in your business, but you definitely cannot write off the entire house. But there's other really cool strategies that you can use. Maybe they use this as a fix and flip. Maybe, even if you're not writing off the house, if you stay in it for 2 years, you can sell it later and exclude $500,000 of gain. You could use this, fix it up, rent it out for a little bit, cost seg it, get the depreciation as the rental, and then you decide to move in it later. So that way you do get the write-off up front, but you are going to have to not live in it for a while up front. I go through like all these scenarios in the Write Off Your Real Estate course. So definitely sign up for the masterclass May 1st, 10 a.m. Pacific, the only time I'm doing it this year. And like, if you don't, you're just going to be in the same situation as you were this year as next year. Because let me tell you, the people that purchase the course, the testimonials are insane on like just how much more knowledge they have for the properties that they already own, or for the people that were able to buy their first investment properties. Like that was so cool to me to hear those stories, or the people that were able to buy more properties faster than they ever thought they were going to, because now they had real strategic advice from me, a real estate investor that's done it a lot of times before. I've seen every scenario on people's tax returns. I've seen every scenario that people have been in escrow in, because I just know so much about their lives, their business, their family lives, how they invest. And they get the strategic advice from my preferred lender as well, who just will give you like every scenario possible, which one is the best for you, based on what down payment amount and the rate and credits you can get and all of this kind of stuff. Like it is literally life-changing money that you will have from taking this masterclass, from getting the course, being in the mastermind call. And if you don't, you'll be so sad, because I'm not doing it again for an entire year. And like missing a year of investing can cost you hundreds of thousands of dollars. The next question: can you discuss investment property and sole proprietorship? More specifically, all the expenses deductible can only go to offset gains from the property or also into your regular job's income? ? You mentioned having a side hustle that loses to owe less in taxes from a regular job. Okay, let me try to decipher this question. Investment properties and sole props. Okay, I think what this person is asking is they have a business that is at a loss. So would their investment properties benefit them tax-wise? Here's the thing with taxes, and this is true for anything, not just real estate, but we can only save you the taxes that you were going to pay anyway. I think people think like when we get our clients $20,000 refunds, $30,000 refunds, $100,000 refunds, because it happens literally all the time, that we just like wished it out of thin air. And that's not true. They're actually just getting back the money that they overpaid in taxes earlier, because they had a shitty accountant that told them to pay more than they should have, and they didn't take the right deductions and didn't have the right structure and all of that. So yes, it's really cool and we look like the hero and we're getting back money for all of these clients, but really what we're doing is we're just bringing their taxes down that they already paid. And the same is true for this. So if you have a sole prop or a business that is at a loss and you have no other income, then you're not paying anything in taxes because you have no income. So having an investment property would not save you in taxes, but what it can do is build generational wealth. And this is really important because you hear me talk about it all the time, hopefully, that you don't want to make financial decisions based on just taxes. And you want to build generational wealth irregardless of the taxes that you have to pay, because you will never pay more in taxes than the money you're making. You know, we hear horror stories of people paying a shit ton of money in taxes, but the reality is, worst case scenario, you're going to pay 60% in tax, meaning you make $100, you're going to pay $60 in tax. Well, you still have $40 in your pocket. Would I ever want a client to pay 60% in tax? No, and nor would they if they were my client. But what this scenario is telling me is you want an investment property not because it's going to save you in taxes, but because you're not otherwise making money. So you need to make cash flow every month. And one way to do that is through rental properties. Now, this person, I would probably recommend an Airbnb so that you have even more cash flow every month. Is it more work for you? Yes. But you're also not making any money otherwise. So you need to hustle a little bit more, work a little bit more, and make more money in your Airbnb property so that you actually have cash flow and you can live your life and you can support your family and you can eventually put it into other investments and save for retirement and build generational wealth and buy more properties. So although this property isn't going to save you in tax, you don't need it anyway. You're not paying anything in tax, I think is what this person is asking. I started an LLC taxed as a partnership in December, and it bought an investment property. Okay, great. This is the scenario I was talking about in the last podcast where you need your LLC before you close on the property. So they did that. We did not rent out the property, but we incurred $15,000 of expenses, mostly prepaid tax and insurance via closing costs. Can we take the expenses in 2023 without income, or do we take them in 2024? Really great question. Okay, this question in particular, they're saying they started their partnership in December 2023. Because remember, the last time we launched this course was in 2024. So they bought a property in December. They had expenses, obviously, before the year was over. And then they rented it out in 2024, like probably January, February, March timeframe when they rented it out. Can they still take the expenses they had before the end of the year? The answer is yes, if. Yes, you can take those $15,000 of expenses if you had the property available for rent. So you might not have had it rented out, but let's say you closed on December 15th. You could have thrown up for lease posting on places like TurboTenant or Zillow or whatever place you like to put that. And it's available for rent as of December 15th. Now, that person probably, if they're reaching out to you on December 15th, they're busy through the holidays. Their lease likely isn't up until December 31st, so they move in January 1. Well, it was available for rent, so you can take those expenses. The same is true for any rental that you have, because sometimes people move out in December, like say you already had this rental going and their lease is up in November, so you put it up for rent in December and nobody happened to rent it for a while. That's called vacancy. So it was vacant for a while, but you can still take all the expenses you had that year because it's not your fault someone didn't move back in, but it had to be available for rent. So that would be my only caveat for this. And this is good to know for any of you that close on properties in Q4. Like, make sure your lender knows that you need to close for sure, like signed on the dotted lines, wires received. It is recorded December 31st, and you throw up an available for rent posting before midnight so that you can take the expenses in that year. If they did not, the person that asked this question, if they did not have it available for rent, they would have to take the expenses in either 2024, or you could add them to the amortization table on your 2023 return, but you'd have to take the expenses over 15 years, which is kind of shitty. Like, that's a long time. So they had $15K of expenses. If they did have to take it over 15 years, they'd only get $1,000 per year, which is kind of crappy. Okay, I also want to let you guys know, not only do you need to sign up for the Write Off Your Real Estate Masterclass, it's free. So like, why the heck would you not join this masterclass to help you learn more about investment properties? Because if you were like me, I didn't know shit about investment properties when I started. And I didn't have anyone in my family that had owned rental properties close to me, except my grandparents, but like they didn't teach me anything about the rentals. But like my parents didn't have this stuff. They were not savvy investors. I was never taught it in school. And damn, I wish I would have started sooner. I just didn't have the knowledge. So let me teach you what I've learned over the last 15 years and all the mistakes I've made as a real estate investor that I no longer have to make, but you don't even have to make them because I'm giving you all the tips and tricks for free in our masterclass. So comment real estate, go to your tax coach on Instagram, comment real estate, or just click the show notes below. But I also have to tell you this because this is another amazing opportunity for you listening. And like, let me tell you, my podcast community is so freaking amazing. You are my ride or dies. You message me every week about the podcast, telling me, you loved this episode. You got this little nugget of information. And I feel like you guys know me the most because I get to just like talk freely on the podcast. Whereas, on social media, we have to be a little more scripted. We have to fit into the stories. But when I kind of teased this on a podcast a few weeks ago, I had so many DMs of like, hey, you mentioned a retreat in your podcast, like send me the link. And I was like, shit, I don't even have like anything ready. We didn't have the dates. And actually, when we had the dates, we messed up the dates. It ended up being Father's Day weekend. And I was like, crap, we have to change it. So for those of you listening, if you're a business owner and you are like, wow, Barbara has built an amazing personal brand. I love her socials. I love how she's leveraging social media and speaking and podcasts and PR and articles and all the things to grow her business. This is the retreat for you. It's called the Be Seen Retreat in New York City. And what better freaking place for branding than New York City? Like, where everyone goes for their like big juicy dreams and like the marketing is everywhere and Times Square, like all of those billboards. It's so amazing. And I can't wait to host. I'm hosting 16 of you in New York City in the best venue ever. And it is June 22nd, 23rd, and 24th. So you can fly in the 22nd because we're going to kick it off with like sunset, rooftop, New York City vibes. Get amazing pictures with the New York skyline at sunset, network with all the retreaters so we all get to know each other, learn about each other's amazing businesses and brands. And then we're going to dive in deep on the 23rd, 24th. I'm going to keep it a little bit secret because you guys know when I do retreats, I throw surprises at you that are always there for you to grow and to get rid of all that crap that is blocking our mindsets. And we're just really going to dive into building your personal brand because I know if you're listening, you're already an expert in your field, but not everybody knows it yet. And so we're going to help you be the authority in your industry, even if there are hundreds of thousands of people in your same industry. Like, listen, I get it. I'm an accountant. I feel like they're a dime a dozen. There's hundreds of thousands of us out there. And if I have been able to stand out in like the most boring freaking industry like tax, you can stand out in your industry too and make a shit ton more money. Like this retreat is going to make you a shit ton more money. You're going to make amazing connections. Like literally just right before this podcast, I got a DM from someone that was at my last retreat. And she said, let me actually pull it up so I'm not making this up to you. She said, attending the Scottsdale retreat was truly a life-changing experience. I went in hoping to elevate my business mindset, and I absolutely did. But what I didn't expect was the personal clarity and intention I gained as well. As a single mom and business owner, I didn't realize how much I was carrying on my own or how much I was missing when it came to implementing systems and focusing on high-level money-making tasks. This mastermind opened my eyes to the power of delegation, alignment, and intentional growth. Barb, your mastermind gave me exactly what I needed and so much more. The mental clarity I walked away with was something I didn't even know I was craving, but now I'll never operate my business the same. Thank you for creating such a transformative space. And then she said in a different message, I'm so glad I found you and this group. Honestly, I truly am. It is life-changing. And that is what happens at my retreats. I've said it so many times before, like hosting events and hosting retreats is not to make money. Like if you guys knew how much these freaking things cost, it is It makes me like cry. Literally, sometimes when I'm signing these contracts, I'm like, well, I hope people show up and I hope people bet on themselves. Like, it is so worth it. Like, let me curate this room that is going to change your business, make you a shit ton more money. The connections alone that you'll make, like the people at the last retreat, they're speaking at each other's events now. They're collaborating in business. They're working with each other. Like when there is hard freaking times. We had a call yesterday and there were a lot of people that's going through a bunch of shit right now. And how lonely does entrepreneurship feel sometimes? But when you have those people in your corner, in your circle, it really changes the game, because there's so many times, and you've probably felt it too, where it's like, this shit isn't worth it. I'm going to throw in the towel. Like, this is so hard. But what success is just getting up one more freaking time when we don't want to. And so I hope that you all can bet on yourself, invest into your own business, and come with me on this retreat. So you can go to Be Seen Retreat, so BESEEN retreat.com, or on any of my socials, DM me retreat, and I'll send you the link. Again, there were only 16 spots. We already have some filled. So by the time this podcast comes out, there might only be a couple left. And on top of it, just so that you know the cost, it's $4,444. I was DMing with one of my clients last night and she was like, holy shit, that's the cheapest retreat you've ever hosted. And it's in New York City. Like, how are you doing that? And I was like, I just literally want everyone to grow their business and know that it's so easy and accessible for them. And we're just going to break the overwhelm. Like, all of you just think it's overwhelming, and I'm going to show you how it's not. And I just want to hang out with everyone in New York City because it's such a fun place. So it's such an accessible retreat. If it's hard for you to make that payment, we can do payment plans for you. Just DM me. Like, I want you in the room and I want you to change your life and your business. Like, you deserve it. Okay, enough about the New York City retreat, although I could talk about it forever. Let's get to the next real estate question. I bought a home for my mom and don't charge her rent. Oh, how can I maximize deductions and what can I write off? Okay, I have so much to say about this question. First of all, if you rent it to someone, I don't care if it's your mom, you cannot rent it for no rent. Like, that's not a rental. You're gifting that to that person. So you're already, like, you could be needing to file a gift tax return depending on how much rents should be. So watch out, because you could be like out of compliance for gift tax. But also, you cannot write off anything if it's not a rental, if you're not making any money off of it. So charge your mom fair market value rent, have her pay you rent, and then this is looked at like a rental property that then you can write off the insurance, the property tax, the interest on the mortgage. You can write off all the repairs, so calling the plumber, calling the electrician, all the utilities that you might have to pay, any of that, you could write it off and take the depreciation on the property. But until you charge a rent and fair market value rent, you can't. I know that that's hard with our parents. So if you could figure out a different way, maybe, actually, we have so many of these scenarios in the Write Off Your Real Estate course. So definitely get the course, sign up for the masterclass. I'm even adding, I have a couple of new strategies that I've thought of since the last time we launched this course on how to get homes for our parents, because a lot of us have aging parents, especially you guys listening. You're like my age-ish, and we all are going through the same shit. But a lot of you probably have aging parents and you're like, are they going to be able to afford their homes later? Do you want them in a 55 plus community? Eventually they're going to need to be in like a convalescent home. And I've come up with really cool tax strategies. It was funny. I was like driving in the car by myself and I like thought of these because that's what I do when I'm by myself. I'm really nerdy and I'm like, okay, what about this scenario? And I know that someone with an aging parent is going to want to move their parents into a 55 plus community. So what if that kid who's like 30 now and the parent doesn't need that community yet, they buy that property in a 55 plus community, but they have to rent it to someone that is 55 plus. So they rent it out now. That person's going to pay off the property so that when their parents move in, it's already paid off. They don't have to worry about it. Like those kind of scenarios, I'm adding them in to the Write Off Your Real Estate course. So definitely sign up for the masterclass. Just click the show notes below or DM me real estate. Okay, last real estate question for this podcast episode. We have a few rental homes, mainly long-term rentals, but one Airbnb. We've had them for a few years, but just recently started an LLC and I work a normal W-2 job. We do not pay taxes. We usually get a few $1,000s in return. So my question is, if we start deducting all of these expenses from this great advice, will it be an enormous loss for our LLC? Is that a red flag? Will our return simply be much larger at this point? Okay, again, a few things to say. So they have a few rental properties and an Airbnb, and they just now opened an LLC. First of all of you listening, please get LLCs before you buy properties. The next thing, they started the LLC, but this person did not say if they've actually quick deeded it into the LLC. So make sure it's not just opening the LLC, but you also have to like title it into the name of the LLC. So usually your title company can do this or an attorney can do it. What we've done is like someone that we know from our title company that we use, she like has this side hustle and she'll do it for you for like $100 or $200 or something, which is cheaper than an attorney. I mean, it's kind of like the black market. I don't know if she's supposed to do this, but she does it for us. And so you can probably ask someone at your title company, or if you have a real estate attorney that you ask, you need to make sure that it's actually like moved over, right? Because then the LLC doesn't actually own it until you move it over into it. And then you want to make sure you have bank accounts for the LLC as well. But to their actual question, they get a few $1,000s in return. Okay, great. But they still likely pay way more in tax because they said they're a W-2 employee. So just because you're getting a couple $1,000s back doesn't mean you're not paying taxes. It could be, let's say you make $200,000 a year and you pay $60,000 in tax on your W-2, whether it's through federal, through state, plus Medicare, plus Social Security, all those things, you're paying $60,000 at least. And you get a few $1,000s in return, that doesn't mean you're not paying taxes, right? So let's say she gets $5,000 back. Well, she still paid $55,000 in taxes. So she still has a lot of runway to get a lot more back. So yes, implementing these strategies, implementing these deductions, implementing all of this could get them a much bigger return up to what they would have paid in taxes. So up to that $60,000 in tax. So that's why we love using all these strategies and deductions. Now, what we will also analyze if we're preparing your tax return is sometimes we don't want the person to get this whole $60,000 back in tax because let's say the last $10,000 of tax was actually just in the 10% tax bracket, because as your income lowers, remember, as your income lowers, your tax bracket lowers. So maybe they started at the 32% bracket and then we lowered their income down and now they're in the 27% bracket. And then we lowered their income down to the 22% bracket. And then we lowered their taxes down to the 15%, down to the 10%, meaning you're only paying 10% in tax on your income. I don't think 10% in tax is bad. I would rather pay 10% in tax and save the deductions for next year, when next year I'm going to be back at the 37 until we bring it down. So that deduction is worth more next year, if you're catching my drift. So when we're preparing taxes, we also weigh, like, how much is this deduction saving them? Because it's not always the 40% if we've brought you down. So to your question, you have probably a lot of runway to save more in tax, but then we would stop it at a certain point so that next year you're still getting a really high tax benefit for these deductions and depreciation and cost segs and all of that. So I hope this podcast was helpful, seeing other people's scenarios and questions. And as always, you can DM me on Instagram. You can go to the Life Changing Money Podcast Instagram and type your questions in there. I love answering them on our socials. I'll answer them in a podcast or our Facebook groups. And don't forget to DM us real estate for the real estate masterclass. And I hope I see you all in New York City at the retreat, June 22nd to 24th. You're going to want to grab your tickets fast.
Thank you for listening to this episode of Life Changing Money. Don't forget to subscribe, and I would love if you left a review and shared it with your friends. See you next time.